Well, good afternoon, folks. We're coming to you on Election Day. I'm wanting to sort of bring to you a forecast or some thoughts regarding where this market is. Take a look at perhaps where corporate earnings are heading and get a feel for what we're looking at in the next few quarters as it relates to economic performance. I have Nick with me and Kevin with me to sort of share their thoughts as well. But Nick, why don't you start off and give us a general idea of where you think this market is and how does it look for corporate America today?
Sure. Obviously, it's down quite a bit on the year. We've had a few different, pretty significant cycles, running way down until January through June, bounced back a little bit, and kind of bottomed out right around the end of the third quarter. So we've seen a bit of a resurgence here as, I don't know if the prevailing thought is that a lot of this bad news maybe is actually priced in already, and that there's a lot of negativity on the horizon potentially, but given the substantial drop we've had, that maybe we're in an okay spot in the market in terms of what we've got coming up.
What do you see, Kevin, relates to company earnings and where company earnings are going?
Right. So, going back to the core fundamentals of the value of a company or a stock is if they're making money or not. And, we've kept an eye on corporate profits in 2022 and then projected out through 24 as well. 2022 profits are projected to come in slightly lower than 2021's, but 23 and 24 are projected to be much higher, especially looking back prior to COVID. We're talking 50% increase in corporate earnings prior to the pandemic. So that's a positive outlook on the market.
Super. And Nick, we're dealing with a rising interest rate environment. We're dealing with a very high inflation environment compared to what we've been used to. How is this impacting the consumer? What do we see on the consumer side of things? As the consumer really kind of drives about 70% of our economic activity in our country, what's this going to mean for us going forward?
Sure. The consumer obviously is going to, their behavior is driving a lot of the market. I mean, the reason that the Fed is pushing up interest rates like they are is to try and make it less attractive for people to go out and spend money, right? They're trying to say, oh, these things that you want to do, maybe they're going to cost a little more, so maybe you're going to try and shift your behavior. We've seen a little bit of that as people have reacted to the rates that have come through. But going forward, the consumer is still pretty well positioned to weather any sort of recession that we have coming up. On average, the consumer balance sheets are very strong still.
Okay. How about income? How about debt ratios, Kev? What do those things look like for us?
Right. So the household debt to income ratio is about 9.5%, which is at a low going back to the 1980s. So, a part of that tick down was mortgage rates going down. A lot of people refinancing their mortgages. That number may start to tick back up as rates increase, but it's still at a very low. Another thing to touch on as well is consumer savings. Consumer savings were at a high coming out of the pandemic, a combination of people not spending as much money as well as stimulus. But there's still about $1 trillion of excess consumer savings in the economy, which helps take on the increased costs of inflation and higher interest rates as well.
Nick, let's kind of flip a little bit and let's talk about these higher interest rates. I know a lot of younger folks today, where they're looking to buy their first home and so forth, are saying, "Oh my gosh, mortgage rates are at 7%." Those of us that are a little more weathered, have been around for a little bit, fully understand the impact of what rates were in the 80s. Can you give us some perspective on that, and what does this interest rate environment mean for us long term?
Right. It's from when we look at that decade, the past decade, it seems so extreme. But as you said, you look back, it's not an abnormal scenario, and maybe rates are kind of where they should be long term. We just had this low for long scenario. I mean, for the past 10 years, it's been rates are coming up, and they never actually did. And now all of a sudden, one year they finally take off. We feel that pain in terms of what it costs us to, go out and get a loan. The 0% car loans are probably a thing of the past. You see that in the mortgage rates, and maybe that does impact how much of a house you can buy, or what else you would potentially spend that money on. If your house payment now went from here to here, then you're going to make an adjustment somewhere else to keep the house. Maybe you're going to defer that new car purchase. But the flip side, in terms of when you're looking to receive some interest, banks are going to eventually start paying something. CDs are starting to come up, money market rates are coming up, and bonds are actually going to pay something. The long-term projections on if you buy a bond or a bond fund now and hold it, and those bonds actually mature, you're at a position where they've been devalued so much that you're going to earn a better than average rate of return going forward. So bonds have pivoted from this safety net position to, hey, we can actually get something. And that has the potential to increase the, in retirement, your safe withdrawal rate that, was 5%, now 4%, and then some people were saying 3%. And maybe that safe withdrawal rate actually comes up.
Gotcha. We've gotten hit pretty hard on the bond side of our portfolios this year. Fortunately, the positions that we took were very, very short duration in terms of how we were looking or the bond side. And because of that, the impact to the portfolios has been less than a longer-term bond portfolio. And certainly we're also at the point where we're capturing those higher rates much sooner now, as opposed to a portfolio that's positioned 10 or 12 years out. Kevin, give me an idea from your perspective what the market valuation looks like and where things are today compared to historical norms.
Right, so touching back on earnings, the market runs on a price to earnings ratio. What's the price of the market versus what's the earnings of the market? We're about at an average, a 25-year average, or around 16.5 on a price to earnings ratio. We're coming into 2022 at a 20 plus ratio. So I think it was projected that number would have to come down at some point. People weren't expecting it to come down as quick as it has, but it's trading about average now, so the market is valued where it typically has been. So it's it seems like it's been more of a sell-off than it has, but it's because where we were trading previously, it's come back down to normal.
Yeah, the drop we've had this year was purely earnings were flat or up for the most part. So the drop we had was much more of a sentimental drop. People are just viewing the market with less favor. But with all those recession and inflation assumptions built in, you were still saying that earnings are expected to continue to grow. So even if we maintain this average ratio, that long-term average ratio, if that ratio holds and earnings are up 15%, that means the market's up 15%. Mm-hmm. There's certainly room for this to continue to grow, even if we see a recession show up in a headline. That doesn't mean the market's down over next year.
But, Nick, I mentioned earlier about the consumer and how much the consumer drives in this economy. And to date, we haven't seen much change in consumer behavior as it relates to spending. There's an index called the Consumer Confidence Index where, they take a rating of how do we feel as consumers. Can you give us some perspective on what that historical looks like, what that situation looks like, from a historical perspective when the Consumer Confidence Index is as low as what it is today? We
bottomed out this summer, and it was funny. We look at these scores; they're benchmarked to 100, right? But when we look at the numbers that we had in consumer confidence, worse than 2008, going back all the way to 1980, the runaway inflation that we had then. So just to imagine that people this summer were thinking that the market scenario we were in is worse than the Great Recession, when you had multiple firms going, like giant companies going bankrupt and housing crashing. We're nowhere near that sort of scenario, but people felt like it was that bad. But going forward, when we hit this bottom, that sentiment number did bounce back. And going forward, the market projections are very, very strong when coming off of that bottom in the consumer sentiment.
Gotcha. Kevin, we're hearing a lot of conversation regarding recession. We talked about it a little on our last podcast, but what indicators are you looking at to say, hey, are we in a recession? What's the story there?
Right. So as we touched on our previous podcast, we're looking at several things. Unemployment is one, and it remains low. It ticked up to 3.7% here in the last month. But, going back to consumer behavior, I think that's another big indicator, and that has not changed to the dramatic levels of recessions in the past. We look at construction and, buildings and activity going on. That has not seemed to change much. most people we talk to, they're projecting 6 to 9 months out of work continuing. Beyond that point, we can't speak to yet, but the common signs of a leading indicator for a recession are not as strong as they have been in the past for recessions.
Excellent. Well, in general, guys, I think that we've covered a lot of areas as it relates to the economy. I'll sort of summarize in saying that, when you look at the valuations of the market's relatively fairly valued compared to historical norms. We're sitting in a situation where potentially we have an increase in earnings, a very positive sign on the earnings side, which ultimately would be able to drive the market. On the bond side, we're looking at higher returns as those shorter-term bonds mature and we receive higher interest rates there. The yield to maturity, if you will, on most of those portfolios are very, very positive. We're in an environment where we're starting to be able to get fixed rates in a 4.5%, 5.5% range. So lots of very positive things to come as it relates to managing portfolios and helping us drive retirement income or reinvestment income inside portfolios. Any concluding comments you guys would like to add?
Well, you mentioned the election. We're here on election day. It's always a comment that comes up is in every other year. People think about waiting to do something until after an election, or they want to see how it turns out. But the data doesn't really show that there's any sort of correlation there in terms of the party in control, who wins. Overall, the long-term trends are just overall positive. What's funny, we see those election years, and the market tends to be, on average, pretty flat until the very end of the year and starts to go up. And that's regardless of who's winning what. So it's more about that certainty, right? That uncertainty, people seem to be, hesitant to do anything. And then all of a sudden, regardless of the outcome, once the outcome is known, it tends to go well. So,
excellent. Nice summary. Kevin?
Right, I agree. I think, consumers are looking for clarity within the market. So whether that comes from the election or the conflict in Europe or what it is, I think, having a basis of clarity, it provides comfort for the consumer.
Excellent. Well, thanks for your time today, folks. I wish you all a blessed Thanksgiving and a blessed Christmas. Fantastic holiday season. As always, feel free to contact us via email, our rep chat, text messaging system, or obviously we can always use the old-fashioned method and actually make a phone call. So look forward to hearing from each of you if you have a question. If not, we'll talk to you soon. Take care.